Hey everyone, welcome back to Fiscal Voyage. My name is Felix, and today's video we're going to talk about a high growth, high dividend growth stock as well, and future earnings growth projected to be double digit, and the potential of annual rate of return for the next few years could be over 20%. So I covered this stocks earlier this month, and it's actually up about $30 since I made a video saying that it was undervalued. So in today's video we're going to cover of that stock and see how's it been and do I still like it. We're gonna look at the fundamentals, we're gonna look at the technical analysis of this stock and see if it's still potential to go higher, and what should we be doing. If you're new to the channel, make sure you hit that subscribe button and like this video if you enjoy it. So let's get started. All right, so you see here on December 4th, earlier this month, I made a video, high growth stock on sale, undervalued stock. And you can see here the stock I was talking about is Cigna Corporation. And at that time, when I created this video, it was at $199.86. And as of now, as I'm making this video, December 29th, is at $231.75. It's up today, $1.21.53%. So again, I think it's still undervalued. It could go much higher. It's not as a greater price as when I made that first video, but still a decent growth. It has still high growth, over double digit, 15% or higher growth. And we're gonna look at that shortly in this video. And you can see here some of the things I like. The yield, of course, since that video I created was much higher. It's almost, I think it was over 2%. Actually, if we go back here, you can see it. Yeah, 2% exactly during that time. And right now it's at 1.74, and actually it's gonna be a little less because it is up slightly today. Earnings are projected to be at $20.41 and given a low PE ratio of 11.30. So it's still undervalued based on the PE ratio. And we're gonna look at some other fundamentals. So if we go to Morningstar gives it a 4-star buy rating. They have a fair value of $283, and right now it's at $230.54. Narrow mode, which is good. It's not great. Wide mode is the better one, but narrow is better than none, right? So it has a narrow mode. So overall, that's good there. Interest coverage solid. Debt to equity ratio very solid. I like to see this at 1.5 and lower. This is under 1, so that's outstanding. And let's look at some of the key things that I like here. You can see the revenue has been growing tremendously. In 2008, they made $48 billion. In 2019, $153 billion. In 2020, $160 billion. And trailing 12 months, so basically this year so far, $170 billion. So revenue is in an uptrend, as well as net income. You can see here $264 billion in 2018. And in 2020, 8.4. So almost triple the net income. So that's that. And some of the valuation that I like, you can see price to sell currently is lower than the 5-year average. That's a good metrics there. Price to earning lower than the 5-year average. Price to cash flow is slightly higher than the 5-year average. Okay, and the price to book lower than the 5-year average. So overall, very solid there. And if we look at the fast graph, even with the, first off, you can see the company, if we take out the price, how the company's just been growing earnings throughout the years. Every year basically growing earnings, except in 2016 and in 2008, where it had an earnings drop of -14, and then in 2016, a -6% earnings drop. But they came back strong the following year. You can see here a 29% increase in earnings in 2017 and a 16% increase in earnings in 2009. But overall, double-digit earnings growth, and earnings are still expected to grow in double-digit rate of earnings growth at 11% for 2021, 10% in 2022, and 12% in 2023. So still tremendous growth in Cigna Corp. If we shorten this time period and put in the price, this is from yesterday's closing price at 230. You can see here, if we go to the mean of around 14.6 or even 15, you still have an annual rate of return about 27%. That's outstanding. This is why I actually bought shares of this company around that $200 price mark when I made that video. So very happy there. And you know, it's not as great as the price at 200, but you still could get good return on today's price at 230, and I'm going to show you why in the technical analysis shortly. But overall, you can see, and we look at the free cash flow, you can see free cash flow covers the dividend very nicely. You can see here the free cash flow payout ratio is only 19.5%. So this still gives the company tremendous opportunity to grow the dividends at double-digit rate, 10-15%, while you're having a price appreciation. So that's very good there in free cash flow. So overall, if we go to forecasting, long term, they're expecting about 10% to 11% growth in earnings going forward, and if we revert back to the mean, you can see around 20 to 29% in estimated total annual return, which is include dividend. So this is why I like this company still, even at today's price. Again, remember I made this video December 4th at $200, saying it was a buy. Hopefully you guys took advantage of that. If not, you could still buy at today's price, 230. Not as great of a position, but maybe nibble some shares there to see, start owning this company. And then maybe if there's a pullback back to 200, buy more shares there. And I'm going to show you the technical analysis of this. And this is why I said it was a great buying opportunity at the $200 mark. So first off, right over here around the $225 is resistance, okay? And if you look here and here and over here, as well as here, let me put a marker here for that. Let me see if we can get an arrow. So I'm gonna put the arrow here so you guys can see where the resistance are, right over here and right over here and right over here. There's two spots right here, you can see here. So right there at the $225 range, the $230 range is resistance. And right now it actually broke it. You can see here at 230, right now it's 231. So it's breaking that resistance. So I see this stock going back at least up to here, which was the prior where sellers stepped in at $270. So I don't see it going straight up to 270. Maybe it'll come back, pull back right here and then bounce higher, because it is pretty extended on the weekly chart. This is the weekly chart, not the daily chart. So for long-term investing, you want to look at weekly and monthly charts. You don't care about the day-to-day charts, but in the weekly chart. So, and also over here, the reason why I said $200 was a good buying opportunity is because you can see in this part right here, it broke 200, but then it came back to 200 and pushed it back lower. Over here as well, you can see this two here, double top over here and over here. It hit that $200 mark and it sold off here. Eventually here, it pulled back slightly, but then went higher up to that next resistance. Then the COVID crash, then all this craziness here. So it came back down here and it bounced. You see it went as low as over here at $191, and then it bounced. It came back here to 200, then bounced higher. Then resistance becomes support once it breaks it. So that it bounced a little bit here, but then it finally broke down. And then over here, it bounced here, right there it bounced, and then it bounced here at 200. And then I made that video like, wait a minute, I think it's gonna bounce again, because that's what's been doing. 200 is a very support resistant mark, a big mark in most stocks. $100, $200, even the $50, $25, those type of marks are big, support resistant area. So, and I knew the stock was undervalued because of the fundamentals. So I'm, thinking, okay, this is great support area, which was resistance, now becomes support. And I think the stock is gonna bounce. This is why, if I go back to this video, I had a buy recommendation. I bought more shares here. And this is why, I had that, my, high growth stock on sale, undervalued stock. So right now it's at $231. And, I see it going back over here to 272 around this area before it pushes back down. But you may want to take profit. I personally won't be taking profit. I'll just continue holding what I have right now, let it ride. If it comes back down, let it ride, do what it needs to do. But if it goes back to 200 or 190, I'm gonna be buying more shares, because it's a solid company. If we go back to the fundamentals, you can see here earnings are still growing. The price goes up and down, whatever it wants to do, right? We just look at technicals and fundamentals to give us the best buying opportunities so that we could make the big bang on our bucks, right? To increase our potential rate of return. So that's the whole goal. So I hope you guys like this video. If you enjoyed it, make sure you hit the like button, and if you're new to the channel, make sure to hit that subscribe button, because I do a lot of videos like this where I go back to previous recommendation, see how they've been doing, see if we could buy more shares of it or don't buy more shares, because doing nothing is a position. You could either be buying, you could be selling, or you could be doing nothing. Those are all positions, and they all have different values, pros and cons. So that's just why I like Cigna. Even at today's price, I think it's still a buy. It has the potential to go up to $270 or so. But as it goes higher, less and less I like it, okay? But if it does pull back to $200, I'm looking to buy more shares. So thanks for watching. I'll see you guys in the next one.